Good morning, everyone. Welcome to this webinar on emerging trends in transition fund strategies. So please be informed that the webinar will be recorded. Everyone in the audience has the microphone and the camera disabled, but you will be able to raise questions in the Q&A box after the presentation. Colleagues, the floor is yours.
Thank you, and good morning, everyone, to this particular webinar. My name is Evert van Walsum. I'm head of the Investor Protection and Sustainable Finance Department within ESMA, and I will provide a short intro to the content. So just as a starter, this webinar is part of a series that we have dedicated to presenting the findings of our research projects in general. So our research publications are available on ESMA's website in the risk monitoring and analysis section. Today's webinar is dedicated to a specific topic, which is the presentation of an article we have published as ESMA recently covering the emerging trends in transition funds. So new investment strategies have emerged that support an economy-wide climate transition and companies in transition alike. And as the review of the Sustainable Finance Disclosure Regulation is about to start, EU regulators, including ESMA, have called for the creation of a transition product category. The focus of such a category should be on investments in economic activities, assets, and portfolios not yet sustainable, but aiming to become sustainable over time. So in that context, we wanted to understand the state of play regarding how investment funds define and implement transition investment strategies. And although transition might in theory be defined as supporting other environmental and social goals, our focus is on investment strategies with a climate transition objective. This fact-finding exercise aims to contribute to both regulatory and supervisory activities alike. So on the regulatory side, the EU framework already provides some tools for transition-minded investors. And these include, for example, the EU Climate Transition Benchmark for index funds. And our analysis thus supports broader discussion around the development of a potential transition product category within SFDR, especially for actively managed funds. Regarding the supervisory activities, fund managers have a responsibility to provide fair, clear, and not misleading information to their clients. And the findings of our work may feed into discussions about supervisory expectations regarding pre-contractual disclosures and investment strategies of transition funds. So let me highlight that transition fund strategies are still an emerging market segment with practices still evolving. So it's important that we keep monitoring the market for new trends and developments. So the Commission proposal regarding the review of the SFDR is expected to be published on the 19th of November, although if you look at internet, a draft is widely circulated right now. So this discussion is very timely. I will now let my colleagues present the approach and the findings of this work and clearly wish you a very fruitful discussion on the outcome. Thank you.
Thank you, Evert, and good morning, everybody. My name is Guylain Kals. I work for the Sustainable Finance Unit at ESMA, working on various topics regarding the inclusion of environmental factors. So I will be presenting today with my colleague Julien Mazzacurati from the Economics and Research Department, and Patrick Carlson from the Investment Management Unit will then take the floor to discuss the findings with us before we open for the Q&A session. So if we move to the next slide, The scope of the work, as Everett mentioned, is really to look at funds that support an economy-wide climate transition and companies in transition. This is and the focus is also on actively managed funds, because we wanted to understand the practices where managers have some discretion beyond the passive tracking of EU climate benchmarks, where funds are basically applying the minimum standards of the Commission delegated regulation on EU climate benchmarks. So based on the recent regulatory evolutions, as background also, it's important to note that managers of transition funds have some common reference points they can build on, especially the existing definition of transition investments that is provided by the European recommendation of 2023 on transition finance. So this recommendation explains that investments in taxonomy-aligned economic activities, investments in companies or economic activities with credible transition plans or credible science-based targets should be understood as transition investments. So it's a non-binding definition, but it provides a common and harmonized definition on which managers can build upon. And then the other piece of the regulatory framework that's important is the ESMA guidelines on funds names, which introduce some provisions applicable to funds with transition-related words in their names. And the two main elements are the application of the CTB exclusions, and the fact that those funds need to make sure that at least 80% of their investments are aligned with their transition ambition and on a clear and measurable path toward the transition. And as Everett mentioned, there have been calls to create also a transition product category in the SFDR review. So we will have, we're expecting to see the final proposal in November, and it will be a very important milestone for this market segment. So in that context, what I will briefly do in the next slide is first explain the approach and how we built the samples, and then cover the main findings that are related to strategy design. And then I'll hand over to my colleague Julien to present the methodology and the findings for the analysis of portfolio investments. So if we move to the next slide, so the assessment builds on two separate work streams: a review of fund pre-contractual disclosures and analysis of fund portfolio composition. The objective of the portfolio composition analysis was to understand whether portfolios are in line with the investment strategy and to what extent they differ from portfolio composition of the broader ESG funds market. And the purpose of the disclosures review was to understand how funds' ambition and investment strategies are defined and how they monitor progress over time. So each work stream was carried out using different sample. So first we built a database of funds with transition or climate-related words in their names. So based on criteria and words that are listed in the ESMA guidelines on fund names. And then we excluded passively indexed tracking funds. So that's how we arrived to a first sample of 121 actively managed funds. And this is the sample that was used for the portfolio analysis. And in parallel, we looked at a subsample of the 42 largest funds in that broader sample. And those 42 funds representing 90% of the total assets of the 121 funds, we think that it's sufficiently representative, and so we conducted the manual review of pre-contractual disclosures on that smaller subsample. So now moving to the next slide, I will now cover the findings of the pre-contractual disclosure review. So first, we wanted to understand how transition-related ambition is defined by the fund managers and whether they are related to portfolio exposure or portfolio level performance or to real economy outcome. And second, we wanted to understand to what extent they are translated into measurable and time-bound targets. So what did we find? The first finding is that transition funds primarily define their ambition in terms of portfolio level performance. So for instance, reduced portfolio carbon intensity, increased exposure to green activities over time. And this is sometimes complemented with an ambition to foster real economy outcome. So what do we mean by real economy outcome? It refers to a measurable change of the environmental performance of specific assets in the portfolio. So for instance, a reduction in the GHG emissions of an investee company. And that's in contrast with a reduction of the financed emissions of the portfolio that could be derived from the transfer of ownership, from the divestment and reallocation of the portfolio into less carbon incentive assets over time. What we also noted is that there are a number of factors that play into decarbonization of the investee companies, which are to a very large extent outside of the control of the fund manager. So making promises, especially quantified promises about real economy outcome, is risky, and that's probably why we did not find any fund that made quantified commitments about that. The second finding is that most funds set their ambition in dynamic terms and translate the ambition into measurable targets. So X% of reduction of financed emissions by over time, X% of increased exposure to certain climate-related activities over time. And one common approach is to commit to the 7% year-on-year reduction of portfolio emissions. That's basically one of the minimum standards included in the EU climate benchmarks. And when focusing also on the fund, so some funds also had some static objectives with a percentage of portfolio that had to be allocated to certain activities, for instance, from year one, without any ambition to increase over time, but an ambition to keep it at a certain level from year one. And when focusing on funds that have a dynamic ambition to increase their exposure or reduce their emissions over time, what we see also is that most of the funds disclose a specific time horizon. So it ranged from year-on-year trajectories to mid and long-term targets up to 250 sometimes, 2050 sometimes. Now, so moving to the next slide. We also wanted to assess to what extent investment strategies rely on the use of asset level forward-looking data for their approach to positive screening. And so when they select and make investment decisions. Positive screening is really one of the key levers for managers to achieve their transition objectives. And we wanted to look at this type of data because the European Commission definition of transition investments relies on such data points, including, as I mentioned earlier, transition plans, science-based targets, and also we looked at the use of CapEx. So what we find is that the most used forward-looking data from companies they're invested in are the science-based targets and the transition plans, as you can see in the graph, and then to a more limited extent, capital expenditures. So it's probably due to still limited amount of disclosures by companies on green capex. Based on the data that we have access to, we could also confirm that when funds are referencing science-based targets as part of their investment criteria, they do tend to have higher exposure to companies with validated targets based on SBTi database. So it was we saw a difference. It was 50% for those funds versus 42% for the overall sample. Then, so on the next slide, I will also mention the fact that ESG ratings are referred to a lot when it comes to selection of assets to the positive screening criteria. So the first observation is that the reliance on ESG ratings is widespread, with more than 90% of funds saying they use rating either developed internally or from third-party providers to make investment selection decisions. Second, regarding the internal ratings, we noted two approaches that are mentioned by several funds and support transition readiness assessments. The first one is classification of investees according to Net Zero Investment Framework, which provides a framework to classify investments according to their transition readiness. And the second approach that we found in several funds was the rating of companies in terms of applied temperature rise. One important point here is that the level of details about the data, the underlying methodologies is often not sufficient to compare the methodologies that were mentioned and to understand how they achieve similar outcomes. The third important finding also is that when they are mentioning external ratings, a few funds explicitly mention the products and the providers that they use, and when they do so, it was not clear how the ratings were relevant to the transition objective of the funds, because most of the time, the products that were mentioned were broad ESG risk ratings that would extend beyond climate. A few words also on engagement. So even though it's not in the slides, but it's covered a bit further in the article, almost all funds reviewed mention engagement as part of the investment strategies. It was almost 90% of the pre-contractual disclosures. However, we were not able to, based only on the pre-contractual disclosures, to make an assessment of the type of actions that are taken. So it would have required to also look at the website disclosures and periodic reports. Now moving to the next slide. So the next thing we wanted to do is, as I mentioned, look at how progress monitoring is done and which metrics are used to monitor progress over time, in particular compared to how targets are set. What we see, because monitoring progress over time against the ambition and the targets is really key to ensure accountability. So the first observation is that there is a high degree of variability in the language and the metrics that are used. So for that reason, we created some categorization to bring a bit more consistency and clarity in the results we published. The main conclusion here is that we found that the metrics most often used by funds managers are measuring portfolio emissions and also climate-related activity exposure. And to a more limited extent also, we saw that managers track progress based on the share of investments that they have in companies with transition plans or companies with science-based targets, or companies that reach a minimum rating score under the ESG rating methodology that they're using. So with that, I will now hand over to Julien for the portfolio assessment part. Thank you.
Thank you, Guilain. So I will take you through the findings of our work on the portfolio side. But before doing so, I just wanted to say a word to explain a little bit the approach that we have used. So what we tried to do was to see to what extent we could corroborate the disclosures and the analysis of the fund documentations and the claims that Guilain just took you through, and see if we could corroborate these with the portfolio composition of transition funds. Now, just a word about the caveats. Of course, the analysis is greatly dependent on data availability and reliability, which, as I'm sure most of you are aware, is typically a problem when it comes to ESG data. So we tested multiple hypotheses, different models, and so on, in order to identify the most relevant variables and to see what we could link basically to the findings on the disclosure side. So what we're presenting today are really just the most interesting features that we have identified, and those that told us something useful about the implementation of transition fund strategies. Now, more broadly, the objective of the portfolio analysis was to identify differences between the portfolios of transition funds with the portfolios of other ESG and environmental funds. So why did we take that approach specifically? So as Guylain highlighted earlier on, a key objective of the work here was to inform the SFDR review. And one big question was, of course, to understand to what extent transition funds deserved a separate treatment from other ESG funds or other environmental funds. If you consider, for example, the definition of sustainable investments under SFDR, which is the only type of investments that Article 9 funds are allowed to make, then there's a very strong chance that these funds will end up excluding all transitioning companies because these companies are not fully sustainable yet, and one way or another, there's a chance they will break the do not significantly harm requirements. So that explains why, even though we're doing this in relatively simplistic terms, we're very much interested in understanding which companies transition funds are investing in, and how it compares with other environmental funds. So with this long introduction, let me take you now through the main findings of our work, and we'll start with the assets allocation. First of all, perhaps the most important finding of the work we've done, at least on the portfolio side, is the fact that transition funds are really heavily invested in equity instruments if you compare with funds using ESG or environmental words. So that's the top charts that you can see here. And of course, there are several possible explanations here, which could be, for example, that the universe of investable firms in which transition funds are looking to invest from a transition perspective are perhaps issuing fewer bonds compared with equity assets or relative to other sectors, either because the companies they invest in are located in developing countries where bond markets are less developed, or it may simply be a reflection of the funding structure of these firms. So there are different reasons that might be behind the relatively stronger share of equity instruments in these portfolios. However, this is such a recurrent feature and highly pronounced, as you can see from the relative difference in percentage points, that we also see that as a very encouraging sign that transition funds favor equity because it gives them leverage to push for changes within the company. So in line with the broader engagement strategies and strong disclosures or claims around engagements that you can find in these funds disclosures. And so then funds and asset managers can push for changes through board nominations, votes at annual general shareholder meetings, and so on. Now moving on to the charts at the bottom, we've looked at the relative sector allocation of the transition funds portfolio, and one very interesting thing we observed is that the average average portfolio share of energy-intensive assets was relatively higher in transition funds. Now, let me explain what we mean by energy-intensive assets here. This essentially captures companies in the industrial and basic materials sectors, which are typically considered hard to abate sectors and may therefore still be doing somehow significant harm. So why did we look specifically at these sectors? So why not looking more specifically at energy sectors, which is an obvious place to start from? So we did have a look at energy companies, both upstream and downstream. And what we saw was that energy producers and utilities also featured relatively heavily in the portfolios of transition funds. However, unlike hard to abate sector, they're also relatively prominently featured in the portfolios of environmental and ESG funds more broadly. Why is that? Well, our interpretation is because the energy transition is a crucial piece of the broader transition, and therefore all ESG and especially green funds are therefore investing in this sector. So you may think, but isn't that what transition funds are supposed to do? More generally speaking, financing the transition. That's true, but transition funds do so by financing companies that are in transition, including then from hard to abate sector. In contrast, green funds support the transition by financing the expansion of already green sectors and activities like the energy sector. So they invest, for example, in energy producers in Europe, where a large share of energy production is from renewable energy sources. They invest in utilities that are increasingly selling decarbonized electricity, and that's not something that transition funds do, or relatively less so than green funds. So really, transition funds focus on these energy-intensive, the so-called hard-to-abate sectors. So these were our main findings on the asset allocation side. As I mentioned earlier, we tested a number of variables. We also found some other differences. They're perhaps less immediately crucial. For example, transition funds tend to be less invested in EU companies, so they invest to a greater extent outside Europe, for example, in the US and so on. But we don't need to go through everything here in the interest of time. So the second main angle we wanted to take you through is what we could call the ESG characteristics of the portfolio or transition fund investments. Again, we've tested a number of different variables here and wanted to take you through two main features that we've identified. And the first one, and one that relates to the use of forward-looking information that Guilain highlighted earlier on, relates to the share of investee company with science-based targets. So for that, we've used so-called SBTI data, and I'm sure most of you are already familiar with SBTI, so I'll be very brief on this. SBTI stands for Science-Based Target Initiative. They're an NGO that reviews and validates greenhouse gas emissions reduction targets based on companies' voluntary submission. Now, quite conveniently for analysts, they also make publicly available the name of the companies that have validated targets. So we've used this and matched them with portfolio data. So what did we find? As expected, but also encouragingly, we see that transition funds tend to invest relatively more in companies with science-based targets compared with ESG and environmental funds. Therefore, quite in line with what they claimed in their pre-contractual disclosures and with the objective of achieving measurable time-bound targets. Another feature of transition fund portfolios we want to highlight is so-called investments in companies involved in what you may call climate action. So climate action is a category developed by Morningstar, which is the data provider we have used for portfolio holdings. And Morningstar identified companies that are promoting clean energy, greenhouse gas emissions reductions or limitations, and climate change adaptation measures. So the reason for looking at climate action here is that we've mainly talked about decarbonization strategies until now, but as part of transition funds strategies, some fund managers focus on these so-called climate solutions. So not just decarbonization aspect, but investment in companies that can help deal with climate change. Unfortunately, the expression climate solution is relatively vague, which makes it also very difficult to identify in transition fund portfolios. So we don't have as precise analysis or data as, for example, when it comes to science-based targets. Nonetheless, because we could see really these climate action aligned assets feature quite prominently in transition funds portfolio compared with the rest of the ESG fund population, we thought it would be interesting to share this finding with you. Now, last bit of information we wanted to share. This is not something that's featured in the article, but just to say that we've been doing our homework. We wanted to provide a bit more details on the econometric analysis that we have used that features behind the results on the portfolio side. So we've actually tested for statistical significance of the differences between transition funds and other ESG funds and environmental funds. So you can see on this slide here the model we have used. Basically, we look at a panel data regression of the portfolio share invested. So that's on the left-hand side, which we regressed on the right-hand side. Transition fund dummy variable at fund level, and a set of controls and fixed effects. The coefficient we're interested in here is beta 1 because that's the one that tells us about portfolio differences that arise from transition fund strategies. I won't take you through the controls. These are relatively standard controls that are used in investment fund regressions. So going directly to the results, what you see here is a chart that plots the difference between transition funds and ESG funds on the one hand, so that's the yellow bar, and environmental funds on the other hand, that's the blue bar. And the bars show the confidence intervals. So what the chart shows is that most of the coefficients are statistically significant, which means that the entire bar is above the 0% line. So this holds for pretty much all the variables we tested, except perhaps the share of energy intensive assets versus environmental funds. But as you can see, even if not the whole bar is above 0, you still have most of the distribution that's above it. One more point we wanted to highlight is that when you control for other factors, generally speaking, the size of the coefficients is slightly reduced compared with the percentages you could see earlier in the descriptive charts, but nonetheless, the results hold, which shows that they are statistically significant. Now, this is it on the portfolio composition, and I give the floor back to Guilain, who will take you through the main conclusions.
Yes, thank you, Julien. So I will be brief because this is basically a bit of a repeat of what we just said. But so mainly, I think what's important is to note that we still see this market segment as emerging with practices still evolving. It will also, of course, be impacted by the SFDR review in particular, with the possibility of having a transition category. I think what we've walked you through that I would highlight is the fact that regarding the transition ambition, funds primarily set their ambition and the targets at portfolio in terms of portfolio level performance or exposure. And this is complemented sometimes by an ambition to foster real economy outcome. And when making investment decisions, the managers are informed by asset level information about transition plans, science target, CapEx. And what we see is that it reflects some alignment with the definition of transition investment that was provided by the European Commission recommendation. We also see a lot of reliance on the use of ESG ratings. And in terms of progress monitoring, it's overall consistent with what we see in terms of how the transition ambition and the targets are set. And we see a prominence of portfolio emissions and activity exposure metrics. And the last point, so regarding portfolio holdings, we see that there are some distinctive portfolio composition features of transition funds when compared to ESG funds and other environmental funds. So with that, I will close. I will stop here and hand over to Patrick.
Thank you very much, Guilain, and thank you very much, Julien. It's always interesting to hear the results of the analysis, and good morning to everyone. From our perspective in the investment management unit, we were particularly interested in these findings as they provide an incredibly useful mapping of the kind of what the situation was for those investment funds that were targeting a transition objective and claiming to do that. I'll say a few words now on our perspective and ask a few questions to the presenters to challenge a bit the findings here and build a little bit on it further. But it's great to see that many of you have already posted questions in the Q&A section of the Teams window, and that's really good. We'll get to those hopefully at the end of my part, and I'll select a few questions for the presenters to address as well. But indeed, so from the policy perspective, SFDR, when it was agreed in 2019 and started applying in 2021, didn't have a kind of very specific product catering for transition. And this was frequently raised as an objection by those who were forced to disclose under SFDR, saying that, well, our product does this more than the sustainable, which is defined. How do we disclose that appropriately, etc.? So that's certainly something that was a live debate for a long time, and that's why it's been useful to see this mapping exercise, also given that it's something that we as supervisors have called for in the Commission's review, that there should now be a transition category, and that specificity can be better catered for in the product offering under the regulation itself. Perhaps I think this all did come through in the presentation, and I'm sure everyone paid attention to it at the time, but perhaps you could draw together a little bit, Guilain, if you could summarize the kind of criteria that the sample funds used, what would be the kind of common denominators that you could draw from this particular sample when it comes to how they define the kind of their success in achieving the transition objective?
Yes, happy to do so. So I think I would point maybe to two complementary approaches when they select assets. So the first one is which is used by almost 2/3 of the funds we reviewed, was forward-looking asset level data as part of investment decision. And there, arguably, I think the objective is to identify assets that are on the path to the transition. And to do that, they looked at whether the assets had science-based targets to reduce their GHG emissions, whether they had climate transition plans, and to a more limited extent also to look at whether they had disclosures on their green capex. And the second approach, which is even more widespread, because what we saw is that 90% of the funds appear to rely on this to some extent, is the use of ESG ratings. So basically selecting assets that have a minimum rating, and in many cases based on a target in terms of the share of the investment that should reach this a certain level of a certain rating. The only issue we noted with that is that we do not see a lot of transparency on the products that are used and how the methodology ensures the product is on a clear and measurable path to the transition when looking at the pre-contractual disclosures. And maybe I can take the opportunity to answer one of the questions that I see on this specific topic in the chat. So unfortunately, it would be interesting to understand what kind of asset class is targeted with those ESG ratings, but this is not something we have been able to do in this work, but it could be an interesting research question for the future.
Thank you very much, Guilain. Yeah, thank you for also addressing that question in the Q&A part. Then that kind of brings us also, your answer brings us, me at least, closer to something that I care strongly about, and that's the disclosure part of this type of product. We are moving from not only a disclosure to also a criterion world in SFDR, but we have always been in a transparency world within SFDR, and that means from an investor protection perspective that there's the fair, clear, not misleading criteria are fulfilled, also by products that want to target the transition. But you already mentioned one thing, but perhaps you can draw some further conclusions from the sample analysis of the specific disclosures that are either lacking or are done well by the fund sample that you looked at.
Yes. So if I were to put myself in the shoes of an investor who's interested in moving his or her portfolio in line with climate objectives, I would probably like to have in the pre-contractual disclosures an explanation of the ambition and the strategy. So in particular, I think what the one thing that we thought was quite a good practice I mean, that I would see as a good practice is the fact that there were some quantified measurable targets explaining how the portfolio will evolve over the short, medium, and long term. So in terms of finance GHG emissions, in terms of exposure to certain activities, I think there's a mix of metrics that is probably, using a mix of metrics is probably going to be the way forward, including metrics about the adverse impact of the portfolio, regarding the share of transitioning companies, regarding the share of climate-related solutions it's invested in. And also, I would want to know the investment strategy, how the investment strategy is expected to deliver on the ambition, and what are the positive screening criteria and the engagement actions that are taken and how effective they are. And I think one point, so you're asking about potentially where transparency is lacking. I think one point of attention going forward for supervisors might be the central role of ESG ratings, because we see it's going to be, they already play a central role for many funds, and with the reduced scope of the CSRD, it might become even more important than we would have expected it to be before. So I think some simple disclosures on the ESG rating products that are used, and the name of the product, the objective that it seeks to achieve, and maybe a link to the methodology can be useful if you're an investor that really wants to understand how things are managed.
Thank you, Guilain. Yeah, that's very good. No, indeed, I was also thinking about the potential future reduction in the availability of publicly reported corporate data, and indeed ESG ratings may play an important role, and in that case, of course, transparency is very important about that. Now, Julien, can I ask you something about the portfolios of the sample funds? Do green bonds feature heavily among them? I noticed you mentioned equity quite specifically, but I wondered if there was also a green bond point. Were they more so or less so targeting green bonds?
Yes, we looked at green bonds, and actually, Patrick, I'll try to answer one of the questions in the chat at the same time, because
sure.
We also looked at the relative share of investments in emerging markets. And actually, when it comes to both green bonds and emerging markets, I was surprised, at least, to discover that transition funds are relatively less exposed to green bonds on the one hand and emerging market companies on the other hand, compared with ESG and environmental funds. So why was this a surprise? First, because if you think about green bonds, at least in my mind, green bonds is a sort of obvious instrument to help finance the transition. But as it turned out, we saw that indeed green bonds represented a lower share of overall transition fund portfolios, but also a lower share of fixed income instruments. So these instruments, at least for the moment, don't appear to play a crucial role basically in transition fund strategies. For emerging markets, it's a bit different. It's not about the vehicle here. It's more that, again, at least in my mind, I would have expected a number of these funds to focus indeed on the transition in developing economies and find opportunities there to help finance the transition. But it turns out that most transition funds have either generalists, let's call them cross-border strategies, and moreover, that then their investments in the emerging markets are relatively less prevailing than other ESG funds. Now, why is that? It's not something we've explored or investigated specifically, so this is not something I'm in a position to answer. I think Murray says in the question whether the lack of transition plan disclosures or relatively less widespread use of science-based targets might play a role in that. That's entirely possible. Is it a feature of this or really just of the geographical strategies of the transition funds? That's not something we're today in a position to answer, unfortunately, but that's an interesting avenue, of course, for future research.
Thank you very much, Guillaume. So this is your chance now. If you haven't posted a question already, you feel free to do so. We have a couple indeed, and indeed the little Q&A I had with the presenters resulted in answers to a couple of them already. There's one thing, Guillaume, maybe the question on external ratings. Indeed, I don't know if you responded to this, or maybe it's just a result of the sample that we chose. But the question is whether we have deeper insight as to whether the funds using external ratings are active or passive, or indeed which asset class tend to utilize them more. And I think that since we went for the active funds in particular, that's the only way we can answer the question, at least that's the case for the active funds. Is that right, Guillaume?
Yes, that's right. I wouldn't be able to answer for passive funds. But I mean, the passive funds are colleagues, Julien, maybe you remember, but I think the passive funds that we took out of the initial sample were to very large extent following EU climate benchmarks in any case. So really applying,
Correct.
The CTB methodology typically, or even PAB methodology.
Yes, exactly.
Okay, good. I think there's a question that maybe I can answer here from Leonardo, that if a fund actively allocates capital to transition-related activities but does not explicitly hard code such objectives in its SFDR annex or investment strategy disclosures, could it still be considered a transition fund? Or does the absence of this formal alignment risk being seen as green hushing, implying that hard coding these objectives is mandatory for credibility and classification? There's perhaps two questions here. One on the choice of the sample, and maybe Guillaume and Julien can comment on that. But in terms of the kind of policy implication of green hushing, I think the whole point of future categories is that they're voluntary. So that the key point is that you want to claim that your product or fund in this case is doing something, and you want to market it as such to investors. And that's when the criteria and potential disclosures kick in for that particular product. That not only do you have to be transparent to the investor about the claim that you're making, for example, in this case, transition, and how it's achieved, metrics, targets, criteria, but you also have to meet the specific criteria of that category. And in that case, we do care very much from an investor protection perspective. If a fund or product wants to be outside the categories, the way at least we argued in the ESA's opinion is that then they should not be able to market it to investors. And in that case, green hushing doesn't have an investor protection problem. And in that sense, there shouldn't be a credibility or classification issue anymore. But only if that product wants to market itself as a transition fund or product, then in that case, it is very important that the hard coding, as you say, happens in the disclosure, and that the criteria for the category are met in the future. Gillian, is there something about the sample was based, I think, if I'm not wrong, on the term being used in the name. So very clearly, we also chose the sample based on funds that were, by choosing that in the name, and of course the ESMA fund naming guidelines create certain provisions when you put those terms in the name, and that's the basis on which we chose the sample. Is that right, Guillaume?
Yes, exactly. No, and I agree with you that a fund might invest in transitioning companies and activities because of return generation or risk management considerations, without really having initially an objective to support the transition. So I don't think in that case, if it's not making any claims about that, then I think it should be fine to
absolutely.
Yeah.
Good. There's another sample question here. The study says the sample is built on the Morningstar fund universe, 86% of which are UCITS funds. After the sample constructions, were there any AIF private market funds? Would you say your sample is more representative of public market funds?
I can take that. The simple answer is yes. 2 reasons for that. First of all, the term transition is really, or transition-related terms, let's call them, appear more generally indeed in public market funds, so publicly available funds publicly available for sale. Second, I would also point to other research that we have done and published, which, by the way, you can access on our websites, that shows that the share of alternative investment funds using ESG terminology in their name is much lower compared with UCITS funds. I think we published back in April some numbers showing that for AAFs, basically the share of funds using ESG terms was about just 5% of the markets. That compared with more than 15% for UCITS funds. So by extension, that also applies to transition-related terminology. And therefore, yes, most of the analysis and the findings we presented today was based on funds publicly marketed and sold, and mainly with a retail investor focus, therefore.
Very good. Thank you very much, Julien. I don't see any other questions in the chat now, so that's I think we can probably end a few minutes early. Hang on, there's one more question. How could SFDR 2.0's transitions category reduce perceived risks and encourage investors to increase emerging market exposure? Yeah, that's hard to know at this stage without the formal draft and obviously the co-legislators' agreement on a final text on SFDR, but let's speculate that there are going to be categories, there is going to be a transition category. Certainly, we believe that the shortcoming of the kind of regulatory permission, the transition box in the regulation for transition, the lacking therefore increased risks for going down that claim route under SFDR 1, and that should hopefully be significantly reduced with a formal category for transition in SFDR 2, and it would allow within the whatever criteria then the category has also to encourage those transition solutions to increase exposure beyond just traditional large cap equity stocks or portfolio goals to also look at emerging market exposure. I don't see any reason that that wouldn't be the case. I think that's a fair speculation included there in the question. I think that's hopefully a good way forward for this particular category. Okay, good. Thank you very much then. It's only my last words here are kind of echoed in Julien's additional question or comment in the Q&A box that you can find all the research publications on our website in the link that's provided there. And that's it for today then, and thank you very much for your attention, and thank you very much to the presenters for your contribution.
Thank you, Patrick.
Thank you.
Thank you all.
Thank you very much.
Bye.
Bye.